point. The idea is you sold the, you see, at the bottom where it says saying I can't release $3 million just like that. After all, that's pretty much. When you're talking to people, buy a nice and anyway, Mike, okay. The Radio 4 of the Zambia National Broadcasting Corporation. It is a good morning and welcome to this edition of the Ndalama Insights Radio Show. And of course, this is the show that empowers you to take charge of your financial future. My name is Leslie Nyangwe, and with me in the studio is Mukonki Mukonkela, who's our financial expert as well as a personal finance trainer. Mukonki, it is a good morning and welcome.
Good morning, Leslie. How are you?
Very well, thank you. And how are you?
God, I'm fighting with this mic. Good morning, everyone online. There's Faith, there's Mwemba, Mr. Paul, Piri. Good morning, everyone online.
It's good to have you here. Now, we are today looking at a very interesting topic that is what happens after you buy your first stock. And basically, this is investing, because this show we basically talk a lot about investing, buying shares, and so on and so forth. So today we're going to be looking at, we say you've been through the process already of getting registered and so on and so forth, and now you're at that stage where you've bought your first stock. So what should you be doing next? How do you grow your portfolio and begin thinking like a real investor? That's what we are going to talk about today. Now, okay, let's start with this. What's the first thing a person should do after they've purchased their first stock?
Thank you, Leslie. So for many of us first investors, we're really excited when we manage to buy our first stock, particularly if we've done it ourselves using the LuSE app. It's very, very exciting. But one thing you should not forget to start doing afterwards is to monitor how your stock is performing. If you've been following me, I've got a framework that I refer to as the path framework. This part of tracking the performance of your shares or investments is the tracking part. It's the T. Path, it stands for, it's an acronym which is PATH. So when you buy your first share, don't forget to start tracking its performance. So you need to monitor. Once in a while, you can check the share price of the investment that you've made. For example, if you've bought a share, let's say Copper Belt Energy, you need to monitor the share price. And in fact, Copper Belt Energy has actually been an interesting company in terms of the share price for the past few weeks. We've seen a slight drop, small drop, weekly there's a small drop in the price, and you need to find out what is happening if you're an investor in this company. And also regularly read financial news or listen to financial news. Whenever there's news, don't leave the news until you listen to the business aspect of the news. It's very important. Just recently, Leslie, we know that Zambia's credit rating has been reassessed by Moody's, right? So this is important news for investors in Zambia. How does it affect my investments, particularly if you're a bond investor? In fact, I think we'll talk about this next week in terms of what are the repercussions or the implications of Moody's credit rating on investors in Zambia. That's something we're going to talk about next week. So this is all news that you now need to start listening to because it affects your investments.
Interesting. So, what kind of mindset, should a new investor adopt once they've gone into this journey?
So when you become an investor, colleagues, we are now building. We are not merely buyers. We are not just buying assets. We are actually building, and we are building towards a goal that we've set for ourselves. So you need to think long term, because when you are building is not a short term project. Many of you that have built properties before, this is not something you do in a day. So the same applies even with investing, particularly in shares. So you need to have a long term view of your portfolio. So think 5 years, 10 years, 15 years, because you're not just buying, but you're building towards a certain goal, a financial goal that you've set for yourself. And also understand that fluctuations in the market are normal. I just mentioned an example of copper belt energy. Yes, the share price has been coming down slightly, but you might be surprised that a few months, a few weeks from now, it's going to be going up. So you expect that fluctuations are normal in a stock market. And so this doesn't mean that you've made a bad decision. It is simply how the market operates. So this requires you to be patient and consistent. That is the only way you become a builder rather than a buyer. You need to be very patient and consistent with your investments. This is the kind of mindset, Leslie, that we need to start adopting as investors.
Now let's talk strategy. Should investors aim to buy more of the same stock, or do you start building a diversified portfolio immediately?
It's recommended that you build a diversified portfolio, but for a beginner investor, first of all, you've got cash constraints. You don't have as much money available for you to spread it across different investments or sectors. So when you are beginning, the natural thing is to perhaps buy one share in one industry. But as you start building, which is why the emphasis is on building, as you start building your portfolios or your different investments, you then need to start looking at different sectors. I have bought a share in the energy sector. I need to buy a share in the financial services sector, perhaps buy stocks in a bank. I also need to buy shares perhaps in a retail company. So over the long term, as you start building your portfolio, this is how you need to start diversifying. Rather than concentrating your money in one investment, which if it's not doing well, may result in you losing money. The essence of you diversifying is to spread the risk. That's the essence. Yes.
So once the decision to diversify is made, how often should I then buy new stocks?
New stocks. So there's a principle. It's actually a strategy in investing called dollar cost averaging. It sounds very technical, right? So what does when you hear about this, what does it tell you? Dollar cost averaging, just for on your on your personal understanding. What do you think it means?
Sounds like something an accountant would know. So
no, Leslie, what do you think it means? I'm serious. Just dollar cost averaging. You don't have to get it right. You don't have to get it wrong. All I'm trying to show is that it sounds very complicated, but it's actually really, really simple. What it simply means is every month you need to invest a small amount of money in, let's say you've selected Chilanga Cement. So what it all means is every month buy a few shares of Chilanga Cement. You could say I'll be buying 200 kwacha of Chilanga Cement every month, and I'll do this consistently for 6 months, for 1 year, for 2 years. That is what dollar cost averaging is. And it's called dollar cost averaging. Well, of course, I'm pretty sure it comes from the US. That's why we have the dollar. We could actually call it kwacha what cost averaging, because the principle is about spreading the risk as well as the share price. Because over a long term, a share fluctuates up and down. So when you are dollar cost averaging, when you are buying a share every month, it means that ultimately your average price will be lower than if you just bought once and at a higher price or once at a lower price. What you're doing is you're averaging the price of the share over a long period of time. That is what dollar cost averaging is. So as a beginner investor, this is something you can actually do. Many people say, I don't have enough money to start investing. Utilize this dollar cost averaging. Spend a small amount of money from your salary. You could say, every month when I get paid, I will be using at least 1,000 kwacha every month to buy shares in Chilanga Cement. And I'll do this consistently for the next 1 year, so that by the end of the year, I can assess and see how much my portfolio has grown. So that's a very important strategy that you could utilize. This is very powerful because it helps you to create discipline. The fact that you are able to set aside a specific amount of money every month really shows how disciplined you are. A lot of people are not able to do this. And secondly, it removes emotional or impulse buying, making decisions based on, what everybody else is doing. Because you've already thought about this, it's now just setting aside money and ensuring that you are reinvesting this money in this particular stock that you've already assessed. And it helps you take advantage of the dips in the markets. When the share prices are down, you buy more shares. Of course, when the share price is up, you buy less shares. So, but it helps you take advantage of the times or periods when share prices are down, so that you can buy more shares. And this is very nice if you actually invest. I know people say the US market, US risky and all of that, but you know what? It's the biggest stock. They're the biggest stock exchanges we have in the world, right? So for me, I think it will be really exciting the day, and I've told you already, this is something I'm working on. The day we'll be able to buy shares. Of course, there are companies in Zambia that will do that for you, particularly financial institutions. But as just a retail investor like you and me, Leslie, I want us to be able to access an international stockbroker and buy these shares internationally, perhaps on the Nasdaq or in England's stock exchange, just foreign stock markets, so that we also take advantage. Look at right now, if you look at Nvidia is one of the most priced companies in the US. It's an AI company. Its share price has been coming down. Now, I was looking at the news last night. It's now trading at around $90. It used to be over $200 a few months ago. Just imagine buying Nvidia. You can become a millionaire. I'm looking forward to the day I can break through to the foreign market.
Yeah, because a lot of people will tell you buy Coca-Cola shares, it's guaranteed that company never falls.
That's the thing. Coca-Cola, Microsoft,
Apple computers. Yeah.
Apple. You understand, right?
Yeah. Okay, now that's interesting. Let's talk about dividends. So, how do they work, and how should new investors handle them?
So dividends are a share of the profits. So for companies that pay dividends, every year we expect them to declare some dividends, so that they repay back shareholders basically a share of the profits. Other companies don't pay dividends because they decide to reinvest their profits back into the company for growing the company. Normally, dividends are paid twice a year. You receive what is called an interim and a final dividend. It's all dependent on whether the management, the directors, or shareholders declare that dividend. So it's a very, for me, receiving dividends in Zambia is very important. You should not buy stocks in Zambia, Zambian stocks that don't pay you dividends.
And there are quite a number of them, so you sort of have to do a bit of research.
Yes.
Yeah.
So there are quite a number of companies that pay dividends, and that we're fortunate with that. And when you get the dividends, reinvest the dividends if you can. That will allow you to buy more shares and will allow you to enjoy compound interest in the long term, because you'll be increasing your portfolio investment. If you are unable to reinvest, maybe save the dividends for a particular goal that you've set aside. Perhaps the reason why you wanted to start investing was to pay school fees for your children. So you could use the dividends to pay school fees for your children, or towards contribution for building property. You could also use dividends in that area. It's also an investment that you're making. So that is how you need to think about dividends. But very key is buy stocks that pay dividends. Don't just buy blindly. There are companies that are on the LuSE that never pay dividends. Find out, and if your interest is in a regular income, avoid them.
Now we often hear about the importance of analyzing company performance. How does a beginner approach this?
So analyzing a company is quite, it's extensive. In fact, people go to school, accountants like myself who spend years studying financial reporting. That's why we go to school to study these things. So for a beginner investor, you need to work with somebody who knows these things already to just explain to you some of the ratios and what they mean. For example, talking about dividend, I think dividend is something that many investors have a little bit of an understanding on. Something they may not understand is earnings per share. So earnings per share simply tells you how much profit you are getting per one share. So the shares that you've bought, for each one of the shares that you have, how much of the company's profit are you getting? Earnings per share is a very important ratio to understand, because if a company's earnings per share is very big, it might be overpriced. It might be overpriced or overvalued. And as an investor, if you're looking at a very huge earnings per share and you get into the market, buy this company, you might actually be shooting yourself in the foot, because there's no room for expansion in the future because this company is already overpriced. So you need to find out, what is the earnings per share of this company? Is it real? And carry out a few, research to just check whether this is a reflective, it does it really reflect the value of this company? Because the one thing about shares is that share prices are normally determined by the sentiments of people, you and me. What we see, what we feel. You said Coca-Cola, right?
Mhm.
Coca-Cola might be overvalued because we think that many people drink Coca-Cola, right? So if I bought shares in Coca-Cola, we just think that this company will never die because majority of people buy Coca-Cola, Sprite, and Fanta. So this is a valuable company. So most times share prices are determined by market sentiment, but then the real value of the company you can glean by reading the financial reports. That's why you need to talk to somebody else who can look beyond the surface, which is the earnings per share, and actually dig deeper and find whether this company is really valuable at the price that is being reflected. And um, and another important thing you need to look for is consistent profitability. Has this company been producing profits year in and year out? And when there's a year the profit is lower, what is the reason? And I know I was looking at some annual financial reports of certain companies on the LuSE. For 2024, there are companies that actually reported reduced profits for 2024. The question is why? Last 2023 we were okay. What happened in 2024? And if you start asking yourself those questions, then you start understanding the value of a company. Mhm.
Okay, now let's talk about mistakes. What are some of the common ones that first-time investors make?
There are a number, so I'll be quick. Some of the mistakes that first-time investors make is they think that buying shares is supposed to give them a quick money, like you're supposed to make a lot of money quickly. It's actually a long-term game. You see the benefit over a long period of time, 5 years, 10 years, 15 years. That's when you actually start seeing or feeling it in terms of the benefit. And then the other one is you starting with small amounts is very important, but you also need to understand that the returns are also going to match the investment that you've made. So if you want to see bigger returns, particularly in dividends, you also need to invest substantial amounts, starting maybe 10,000, 50, 100, 300. Those are the amounts that will give you dividends that are going to make sense to you. So when beginner investors see that I'm not seeing the benefit, they want to sell because they don't see the benefit short term. That's a mistake you need to avoid. The other one is following the crowd. Many people will hear radio programs like this. Mkonki is talking about Airtel, Mkonki is talking about Chilanga Cement. Without even doing further analysis, you go and log into the LuSE app and buy those shares. Yes, this is just for information purposes, the radio program that we do. You need to go further and dig deep and validate for yourself whether really this is a good investment or not. So that requires you to go do further research rather than just following what people are saying. And finally, a lot of investors invest without a plan. They hear people talk about, it's like gambling. I mean, a lot of young people will hear about this bet something online, bet whatever, without understanding that they can actually lose. They go and start playing these games and eventually end up losing. And not even young kids. I've actually heard that even older adults do this. So they will go spend the money and are afraid to go home.
Yeah, yeah. Now let's look at the tools and resources. What would you recommend to help listeners grow their knowledge?
Okay, so knowledge is fundamental. Don't rely just on Mukonki, guys, or whatever some other financial analysts that you've heard talking about these things. You need to get the knowledge yourself. And yes, listening to programs like this is part of getting the knowledge. Why is knowledge important? Um, it's going to help distinguish you from just mere investors that invest blindly and you're going to buy valuable companies despite the share price. Okay. And where do you get this knowledge? Read, first of all, the most important report in Zambia is the daily stock summary report. You find it on the LuSE website. If you're buying shares and you don't know what this report is, you are investing blindly. I can tell you that. It took me a while, Leslie, to start investing in shares. You and I have done this program for years. It took me a long time for me to start buying shares in Zambia because I needed to understand the market dynamics. And when I started reading the daily trade stock report, I started understanding investments in Zambia in shares. If you are an investor in shares, this is a report that you need to read. And in fact, this is the only report that you need to read if you are an investor in Zambia, the daily stock summary report. Get it on the LuSE website.
Important indeed. Now we've come to that time, unfortunately, we've got to wrap it up. But before we go, could you tell us a bit about your online course and how that works?
Yes. So let's see, because a lot of people are interested in buying shares and buying bonds. We need to make these things practical for individuals. So Inside Partners conducts online training programs. Every Friday, we look at investing in shares. How do you buy your first stock? How do you assess which stock to buy? So it's Friday morning from 9 to 12. We just look at investing in Zambian shares. This is an online training because I want us to get as many people across Zambia, even worldwide, that are interested in the Zambian stock market to attend this training and invest with confidence. Every Saturday evening from 18 to 21, we are looking at investing in GRZ bonds. How do you buy your first government bond? How do you open a CST account? So that is what we try to do, to apply the knowledge that you've been gaining and become a real investor in building wealth over a long period of time. So these are the two workshops that we have at the moment.
Great. Thank you very much for making time and coming through to the show today.
Thank you so much, and thanks to everyone who was online. Thanks, and have a good morning.
What's to start investing? But don't know where to begin?
All right. So, internet